Hello, everybody, and welcome to this panel, the Disruptive Investment Strategies for Family Offices panel. My name is Jean-Luc Gustav, and I'm head of Asia for GDA, group of companies. This topic is a great topic. It's a great subject, probably one of my favorite. Having worked for a family office myself for a couple of years, with all the intricacies that come with that, and the multidimensional aspect of the decision-making process, and the relationship to emerging technologies, which is exactly the subject of this panel. So I'm here with three very talented individuals on a truly international panel. We do have Ali Madhavji with us, managing partner at Blockchain Founders Fund, based in Singapore, although he's somewhere else. But I will let him introduce himself in a second. Denise Holzer, managing director for Chatsworth Securities in New York City, and Brendan Halavi, founder and managing partner for CoinArc Capital, sitting in California. So to start with, thank you very much, guys, for being with us on this Family Office Summit. And I would probably like each of you to introduce himself in 30 seconds. Ladies first, Denise.
Hi, everyone. I'm Denise Holzer. Thank you, Jean-Luc. Appreciate it. Happy to be here. Thank you to GDA Capital for including me. I spent close to a decade at Morgan Stanley in New York on the wealth management side, managing money for family offices. I ran the business with my brother, who still runs the business out of New York and Connecticut. So I'm a licensed security individual. I left Morgan Stanley because I started a tech company. Did that about 4 years ago, and when I transitioned into running the tech company, I raised the capital for it. I moved my security licenses to an investment bank called Chatsworth Securities that's based in Greenwich, Connecticut. That's a boutique investment bank, and for the last, I would say, about 4 years, I've been working with some select family offices that I had relationships with from Morgan Stanley, looking into the blockchain space. So we went on a journey over the last 4 years looking at investments in that space. I also work in data and AI from an investment banking perspective. So I've worked with companies raising capital and advising them in a focus with tech, AI, data, blockchain.
Fantastic. Thank you so much for being with us. Brendan, would you like to say a few words about yourself?
Sure. Hi, everyone. I'm Brendan Halavi. I'm founder and managing partner at CoinArc Capital. We are a relatively new liquid token hedge fund. My background prior to crypto was in commercial real estate. I was buying and syndicating multifamily deals in Los Angeles County. Transitioned to crypto full-time roughly 18 months ago. It was way more interesting and did not want to argue with the city anymore. I was just investing and participating in a variety of different projects. And back in October of 21, I co-founded an NFT project called SoulSphere on Solana. We basically just created, like, in short, like a digital land concept where you can showcase all your NFTs in one place and put a link on your social media bio, rather than just uploading one profile picture at a time. And after that, in early January, I had actually sold my entire crypto position and liquidated all I sold everything, just in anticipation of where we are today in the market environment, which turned out to be a good trade. But then really just use that capital to start CoinArc, and not only with my proprietary capital, but have raised money and actively raising money from high net worth individuals, family offices, and some institutional capital, but really just to take advantage of the market conditions and the depressed prices right now. And we are a thesis-based fund. We invest solely based on our theses, which we have a few of them that would love to talk about. But thank you for having me on the panel.
Fantastic. Fantastic. A lot to discuss indeed. Ali?
Absolutely. So thank you so much for having me. So Ali Madhavji, managing partner at Blockchain Founders Fund. So we invest in and help venture build top tier startups. We've now got about 100 portfolio companies all across the Web3 space. So we've been doing this for a while. We're also LPs in a number of other funds across the blockchain space. And we've worked quite a lot with the United Nations and INSEAD. So we, helped write one of the first academic case study in the world on Binance with CZ, the founder at Binance, and many others. And then I also serve on the board of a couple of public companies in the Web3 space.
Fantastic. All right, cool. So today we are going to speak about disruptive investment strategies, especially for family office. So obviously, the reason why this topic is always extremely interesting to me is because, having worked myself for a family office for a few years, we all know that a family office, and especially a single family office, is essentially about preservation of wealth, but also preservation of the values of a specific family and passing those values to the next generation. And precisely what we see is, on my side, on my perspective in Asia, is a lot of next generations getting more and more interesting into doing things differently, looking at market opportunities differently, and obviously putting tech in general and emerging tech in particular at the center of their business. And this is where this topic is becoming very, very interesting. Family offices are usually considered conservative. This is what everybody usually say. I would very much like you to hear what you guys have to say about that. I run into a recent Fidelity investment survey that revealed that 22% of 400 institutional investors, including family offices and foundation, have explored investment product related to digital assets and related to technologies. Does this mean that necessarily it means that those family offices are already ripe for investment, or are they just curious? This is also something that we need to discuss. And we also see that a lot of those investors experience difficulties exploring and assessing the potential of blockchain technology. They find it sometimes very, very difficult to identify the right partner to, who understand their business, their values, can connect them to the extremely promising but still very nascent value propositions of this new economy. And this is why that's why we're here. So, my first question would probably be about, a basic reality check. Disruptive investment strategies. Everybody is saying, and Brendan, this is what you were saying, family offices are changing. They are flocking into tech investment, maybe even into crypto investment. Is that really a reality? What do you have to say about that?
Yeah, I don't know if I would use flocking, but I think you can go back to the crypto markets and their correlation with equities from 2009 to 2020. Mm-hmm. These were like very uncorrelated markets. You had like the crypto markets had these 4-year cycles. Equity markets were just kind of like slowly appreciating and moving up and to the right. That all changed in 2020. We saw there have been a direct correlation, especially on like the longer tail of the risk curve with the NASDAQ. And you can only speculate why that is. I truly believe that, Paul Tudor Jones and Stanley Druckenmiller, these kind of like hedge fund gods, came out in 2020 and were just these guys were advocates for blockchain and PTJ Moore for Bitcoin. Stanley Druckenmiller just came out, a couple months ago. He said, if I was a younger investor, I would be highly focused on blockchain. That removes, when you have, two figures like that removes a lot of the career risk and lack of a better word, social risk from investing in crypto. And it does make sense. If these assets are correlated now, these same buyers who are buying equities will be the same buyers who are buying crypto. And I think if we see this year, the same sellers who are selling equities are probably these same sellers who are selling crypto. I think also family offices are just starting to see what's going on in the world. Like Instagram just announced their partnership with Coinbase wallets and Dapper Labs. NFTs are coming to Instagram. You're gonna overnight 2.9 billion people are gonna get NFTs. 1 in 5 Americans have dealt with crypto in some way. So I think they're just starting to really see the writing on the wall. I don't know if they're flocking as far as like putting a substantial amount of their balance sheet into it. One is that the tools are not ready yet, other than investing in other than being an LP in another fund. Family offices with substantial size will not self-custody. They just will not do it. They will not trade derivatives or perps. They just want to own the asset. And that will change. I mean, BlackRock, they just announced their partnership with Coinbase yesterday.
Yep.
For their institutional side. So these things are coming. But they're just coming. And I think family offices, they're learning volatility is not risk. I mean, this is when I was, to wrap it up, when I was speaking to a lot of like high net worth individuals and also like family offices, their biggest concern initially was, these things are risky. They go down 80% one year and they go up. But I think with proper risk management, they're learning, and obviously on a long-term time horizon, we've seen with the longer assets like Bitcoin and Ethereum, their volatility is not risk when it's your friend. It is just poor risk management that you blow up. So that's what I'm really starting to see.
Yeah, I could not agree more. This is something that I personally experienced myself. This transition from why are we exposed to, from a family office perspective and a single family office perspective, why are we exposed to those things, to why aren't we exposed to those things? So it's especially interesting because, again, a family office by essence is created around the notion of, capital preservation. Right. So I find this quite interesting. Denise, do you have something to say about that? I'm sure you have some experience to share.
Yeah, I would say that family offices on average, generally haven't been in the crypto space. I would say only probably 25% of a typical family office in the United States has invested in crypto. And I think family offices on average, allocate approximately, 35% of their portfolios to alternative asset classes. And within those alternative asset classes, I'd say 10 to 25% accounts for private equity. So, it's a small percentage from family offices. I think generally the family offices I've worked with and, dealt with over the last decade and a half, I would say that, just similar to what you mentioned, you're looking for capital preservation. And so you're looking for ways to, take your money and just get yield off of it. And unlike, the crypto world where people expect the yield to be 10% plus because that's what they've seen over the last decade, the typical family office who's, had a business and, worked very hard and accumulated capital, their risk to reward at that point when they've accumulated the capital becomes very different. They want to preserve it, right? Yeah. So they're going to maybe take 25, 35% of it and, invest in alternative assets where the rest of the portfolio will really be income producing for them, right? Capital preservation, or they might look at investing in real estate. And when they look at real estate class, they'll invest in workforce family housing, perhaps in this market, which does well in both booming and recessionary times. So I think the typical family office is not going to be taking a large amount of capital investing in crypto, but a lot of them are interested in it now, and it's a portion of the portfolio. I think to what Brandon was talking about as far as tech, I've actually seen, an opposite move, I would say, in the last I would say in 2022, there was a large move away from tech, right? People are, family offices are looking for really companies that are generating capital, that they're not investing so much in early stage tech companies. They're looking at companies that are going to be able to, do well in rising interest rates environments. And that's, why they want to see companies that are already generating revenue.
All right. Thank you very much. Ali.
Yeah, absolutely. I mean, I think our experience. So we raised a new fund over the course of this year, and so we're a Singapore regulated fund. We invest in early stage venture. So we're in Web3, right? So we're almost at like in some ways, relatively high risk side of the spectrum. And what we've seen has been surprising. So we've actually got some of the largest family offices from the United States, out of mainland China and Hong Kong, out of Singapore, that have invested in our fund. And that's been, I think a real testament to things starting to change, which I think has been alluded to, right? I think over the last year and a half, you've seen a lot of interest in learning about the space, but oftentimes like a lot of hesitation on really executing coming into the space. Sometimes they'll see like another family office or two sort of take the lead, try it out, see how that goes over a little while. Then they might come back and say, hey, we saw that this went really well. We want to sort of start getting more involved, right? Mm-hmm. Bitcoin in reality, easier to hold from like in some ways. I do think we still see the custody problem as Brandon sort of alluded to, but there are a number of custody solutions that are out there that, can be relatively easy for, say, Ethereum, Bitcoin, some other assets that are sort of top sort of cryptocurrencies, where ours is sort of differed. And I think made it a lot easier for, major family offices to come into all across, from private equity to real estate to F&B. Has been that we invest really, really early into ventures. And one of the challenges that a lot of family offices have seen and that we've heard is they're seeing these crazy valuations on companies. And they just don't want to be at the short end of the stick, being sort of at the end of that, coming into these, growth stage companies that really only have metrics similar to seed stage companies, right? But the valuations are sort of at that growth stage level. And you see a lot of that in the Web3 world. There's just a lot of capital that have sort of created this inflated valuation sort of sign. Whereas our strategy has been to come in at pre-seed and seed. And what we've seen with a number of our investments has been very, very quickly, they benefit from a lot of that capital in the market, and their valuations do, sort of go on to this, I'd say accelerated trajectory from a valuation standpoint, right? So I think that's been easier and more palatable for some family offices to look at traditional venture. They already invest in venture. They've already done some early stage, not necessarily a ton, but then that angle has sort of worked, I think, in our favor. But yeah, I think there's still a big movement for a lot more, right? I mean, even when you look at some of these inflation problems that are being caused right now, at some point, Bitcoin may well become the inflation hedge that many of us think it ought to be, right? And I don't think that's fully happened yet. In reality, I think most of that has not happened yet. But there's a lot of hypotheses out there that this will happen.
This is probably the most controversial thing that you could say right now when it comes to the Bitcoin thesis, right?
Yeah, because it really didn't act like an inflation hedge over the last few months. So it actually proved not to be an inflation hedge. I think, family offices, if we're focused on them, are really looking to preserve capital. And I'm sure a lot of people who made their wealth and have become family offices now in the crypto space are certainly rethinking how they invest their money as well. And generally, you want to take a certain percentage of your money and live off the income of that money when you make money. And then you take a certain portion of it that is the money you risk, right? And you can take risk with. I think one of the reasons why you haven't seen a huge move of family offices investing in this space is because their money wasn't FDIC insured. And we saw that with companies like Voyager, and that
Celsius.
are now in bankruptcy, and Celsius, and anyone who had their money in those accounts, right, won't be able to access it any longer, right? And so that's why, smart money, was hesitant to invest in this space. I would say that, smart money will take 25% to 35% of what they've accumulated over a long period of time, in some cases a short period of time in crypto. And they will take risk with that, because without risk, you don't get reward, right? So if you just keep your money, in bonds, you're not getting much interest in the bank. Maybe as interest rates rise, people will start to look more into getting safer money with interest rates than bonds. But, over the last decade, you didn't have that opportunity because interest rates were so low. So people had to look and take risk in how they invested. So I think, those are some issues. I think as, we're still in very, very early days of digital currency. I think digital currency is here to stay. I think it's a really exciting space as an investment, in early stage tech companies, specifically in custody and insurance, and in ways to protect your assets. And I think you're going to start to see a lot of really interesting companies change the space and make it more, sort of feasible for family offices to actually invest in it if they feel that their money can be safely protected.
Okay. No, that's very, very interesting. Let me ask you a complementary question to that.
Sure.
I mean, my experience in Hong Kong, for example, in Asia in general, is that we are in touch with a lot of family offices in Asia. Family office, the very concept of family office in Asia is relatively new, and this money that we are talking about has been accumulated over a relatively recent period of time, compared to all the money in Europe or even in the US. And interestingly, we are in touch with a lot of young kids. I mean, I call them young kids because obviously I'm older than them. And one of them, for example, we are in touch with a large family office in Singapore, for example. They are now making a complete move on digital assets, on NFTs, on Web3. But interestingly, it's because that in this particular case, which is not so frequent in Asia, the transmission has happened from the patriarch to the young kids. And those young kids are in their 30s, early 40s, and they are now going full on Web3. Which brings me a question. Would you agree that usually the interest for digital assets obviously is correlated to the generational transmission of money, or is it just irrelevant?
Yeah, I think it's a hot topic right now. So if you're young, you want to be in digital currency, you also haven't lost money yet, right? You're taking your investment.
That's a good point.
So, you haven't actually gone through that. But, with all risk, there's rewards. You have to weigh what the risk and reward is when you think about how you invest your money. You're not going to make a ton of money unless you take some risk. The question is, what percentage of your portfolio are you going to take that risk with? And I think that's a question that, I see a lot of young investors in the space not considering, right? So if you've suddenly accumulated a ton of wealth because you bought Ethereum or Bitcoin, years ago at a low price, and you held on to it and you didn't take your 3x return, which most people in the investment space think is a lot, and you made 10x or 100x on your money, Now you've made, quite a bit of money and you're sitting on it. How are you going to invest it? Well, the average family office, only takes about 35%, 25 to 35%, and takes risk on that. So you have to rethink how you invest, because when markets go up, it's great to buy things, right? Because they'll continue to just go up, maybe, but they can also go down. So you have to really consider your risk to reward when you're investing. And I think younger investors, haven't maybe lost money yet, so they might take more risk.
You know what? I never thought about it in those terms, but I think it's very interesting. They haven't lost money yet.
I don't know if I necessarily fully align with that. I mean, we've got a number of our investors that run massive single family offices that are past sort of the earlier years of their careers, and they're sort of in the later stage of their careers. And I think they've also seen a lot of the trends of what's happened in the world and the way the world can change. And we're talking about transformational technologies that are going to change nearly everything about the way that things operate, right? So, and I think oftentimes this is forgotten, right? So when you look at blockchain at the core, this is the first way in human history to basically solve multi-party trust issues, right? You look back at 2007, 2008, and it eroded a lot of trust in financial institutions and the corporate world and Wall Street. And then you look at what's happening now with inflation, and it's eroding our trust in government institutions. Many of the people in the crypto industry already didn't necessarily have a lot of trust in these institutions, but now it's the widespread public. Anywhere you go, people are talking about this. And this is very critical to creating substantial efficiencies in the business world without the need to rely on these different parties. And then you look at NFTs, and it's our first way in human history to track digital ownership. And in what world are we going to live in where we didn't think we needed that? In 20 years, we're going to think it's crazy that we thought we didn't need to track digital ownership. I mean, imagine you couldn't track ownership of your home. I mean, you wouldn't buy a home in those places where they don't have proper land registries and title registries. And so when you start factoring in these sorts of things, I think some of the family offices that we're seeing that are older understand these shifts and understand what's really happening here. And I think they also understand that 95, 98, 99% of the stuff that might be here is also part of that hype cycle, which is very common. I mean, if you go back into the emergence of tech and the internet, I mean, a lot of the companies that started then and were part of the tech bubble are no longer here. But that just means that some of those companies are going to emerge as juggernauts, and many others are coming along the way once some of those mistakes have been made.
Yeah. What do you guys think about what happened yesterday with Solana?
No, I mean, there's definitely a lot of challenges, right? I'm not saying that there's not a lot of I mean, there's a lot of blockchains that don't scale effectively, that have security issues, right? There's
scalability, security. Yeah,
exactly, right. We've got the CeFi issues that are. We've got the centralized finance issues that are going to impact people coming into this industry for years. I mean, people that lost money with Celsius, like people that lost money with Voyager, like these are huge problems that this industry needs to get over. And it's some of those are a little ironic because this industry prides itself on transparency and these types of principles. And obviously these were extremely opaque situations that didn't follow a lot of these principles, but it's still burning people from this industry. So I agree. There is a lot of problems and there are a lot of challenges that we need to overcome still.
How do you protect yourself as an investor from knowing which is the secure chain and which is not? I mean, had you expected what happened to Solana, over the last couple of days to happen? Was that something that you guys had foreseen?
I mean, I can comment on Solana. The Solana issue was not a layer 1 issue. It was an issue with a software wallet that was built on top of Solana. It is definitely not ideal for people to lose money. It is not recommended. There are way more risks in crypto than there are in traditional finance, just because the regulatory environment has not just been introduced yet. It will come. I think it will first come with stable coins for sure. But I mean, I don't see it happening anytime soon. I think it's going to take a long time for Congress to pull it out until certain events do happen. And I think that, we saw with Three Arrows Capital, with Celsius and Voyager, a lot of these regulators are saying, hey, we have to get on this stuff because we need to protect the investors. Just going back to the fact of where people haven't lost money, I've seen a lot of people lose money in crypto, like a lot of young people. I think I don't necessarily know if it's because of that or it's because investing and NFTs and this kind of stuff has become mainstream culture. Therefore, younger people can relate to it much more. I don't know. I mean, if Bitcoin is a digital gold narrative, I don't know any young person who holds gold as an inflation hedge. But I know a lot of young people who buy Bitcoin because they're like, I'm just going to save in that.
The difference between gold and digital currency is that you can hold the gold in a safe deposit box, and you hold the key to that safe deposit box. In digital currency, you can have a hack.
But we're not talking about hacks of like cold storages, right? Like these issues have been hot wallet issues. I mean, if you're holding it with a trusted custodian or in a cold storage, like you are safe from that perspective, right?
Yeah, absolutely. I mean, the narrative, not your keys, not your crypto, has never been, as true as, as now, basically. So yeah, a lot of things are happening,
I know what Denise is saying. It's not easy for people to go and just kind of buy these assets. And like we were saying, like family offices are not going to self-custody. They're not going to buy a USB flash drive and put the assets on.
Right. And so what's going to happen over the next decade is there's going to be really interesting companies that Ali is going to probably look at that are early stage companies that are going to be creating solutions to make it easier for institutional clients and family offices to invest in the space because they're going to have, protection on their money, right? It's not necessarily regulation. That's great too. It's hard to regulate, obviously, this market, but obviously the digital currency is moving into being regulated by the Chicago Board of Exchange. But I think it has to do more with protection on your money, custody, insurance, things like that. So I think the products that come out of the space that make investors feel secure are coming for sure. I've seen many of them. I've started to look at a lot of these investments where I have family offices that want to invest in these things. So there are early stage companies that are looking to solve these problems, but obviously it's not an easy thing to solve. But I think we're going to see a tremendous amount of new companies come out in the next 5 to 10 years that will hopefully solve this problem. Now, another whole issue that we haven't started to discuss on this call is what happens with quantum computing when quantum breaks cryptography. So, that's a whole other issue that, people are worried about, are afraid of. There are security companies that are looking on how to solve these problems. The US government just announced that, they're going to spend tons and tons of money to try to solve this because the Chinese are spending $80 billion a year on it. So they might have broken our cryptography.
No, these are definitely challenges. I think one that we also didn't talk about, right, is, family offices, a big part of it is also being able to transfer wealth effectively, right? And, one of the things in crypto is pretty much right now when anyone dies, they have no way of transferring that crypto to their loved ones. It is a big problem.
So right? that is one of the biggest issues, and that's why I'm sorry if I didn't get into the details. When I mentioned insurance, I was talking about ways to protect your assets and leave them to loved ones. So usually when you have an estate or a trust, you have insurance in place.
This is also a problem that impacts, retail people as well. Initially, I'm a lawyer by training in France, and I remember this incredible statistics. For example, life insurance in France. Just to take France as an example, right? I think there is like 20% of life insurance contract that are lost. the companies, the insurance companies, just don't know who this money belongs to, because that contract was probably signed by someone who died without leaving any instructions. So basically, they have to look for the beneficiaries, and it can take a very, very, very long time because they just don't know. And we are talking about billions of dollars. It's not small money. We're talking about billions of dollars. So if that happens in traditional finance, just imagine. I mean, we haven't seen that yet happening in the crypto world, but it will probably be worse, right?
I have a feeling those insurance companies aren't looking too hard for the beneficiaries. But
probably
besides,
well, the thing is, I mean, in some countries, France, for example, they have a legal obligation,
of course,
to look for those beneficiaries.
No, of course. But I think one of the interesting things in crypto, like we just invested in a company called Lightbeam that's working on will and trust solutions, right? And the idea is, doing something on chain where if you have essentially this heartbeat check, and once that heartbeat check stops, it'll essentially transfer those assets at some rule set that you would have put into place to your loved ones. And so there is different solutions like this that are being worked on to try to solve some of these major challenges that are there, because pretty much everyone right now, the vast majority, would lose their crypto if they were to die, right? Like, and this is a problem that exists, right? Unless you've actually got custodian solutions, which most retail do not use, et cetera, right?
Yep, absolutely. Let's move to the second topic. I would like to maybe to dive a little bit into the why. What are the driving forces behind the interest for disruptive investment? Do you guys think? I mean, what is the predominant force? Do you guys think it's FOMO? Is it for learning? I mean, I don't want to be left behind. I understand there is something happening, and I just want to learn about it. Or is it because there's a true belief that those emerging tech are going to change the world, or is it just pure opportunism? Basically, we saw what happened, early 2000, that led to the Google, the Facebook of the world, and we don't want to miss it. So basically, we are just going to to invest into those things because we expect Solana, for example, to become the new Google of tomorrow. What do you think is the driving force behind this this shift? Maybe we can start with Brendan.
All the above. I mean, it's no. I mean, greed is definitely real. I mean, yes, there are various different institutions and family offices and people who want to learn, so therefore they invest a little bit. There are people who really do believe in blockchain, so they invest accordingly. But yeah, I mean, maybe there are people who they're just susceptible to FOMO, and they see their peers and they see other people they're making tremendous amount of money, especially in the euphoria of the last 2 years, and they just don't want to be left out. They said, it's okay, I'll put 1% or 2%, whatever happens, as long as kind of like I can't imagine a situation where that person makes a lot of money and I don't. In all these scenarios, there will be allocations to crypto, right? In all of them, right? And for the better or the worse, it will be a learning process for everyone, and they will learn exactly what they would be investing. They would be investing in.
Yeah. I was obviously thinking about the inflationary pressure, low expected return, loose central bank policies and liquidity. I mean, this type of things, more connected to traditional finance, maybe. What do you think, Denise?
I think it's the 10 to 1,000x returns that people want, and I think that everybody wants to have invested in Bitcoin when it was $300 in 2012, 13, and then see it go to 60,000 and actually hold on to it. So I think those are the things that people want. They want to be an early investor, in Facebook. People dream of these things. And, the question is, what portion of your wealth will you take that risk with? If you want to go all in, there's risk to reward with that. But I think, when I talked about young people not having lost money, I'm sure many of them did over the last, this year in 2022. I meant for a long period of time, you didn't lose money. And then in 2022, you did. And so what I'm trying to point out is it's just a question of, it comes back to the question that every wealth advisor is going to say to their client is, what is your risk to reward? What is your time horizon when you think of your investments? How, do you need liquidity? If you need liquidity, you want to have safe money set aside. You want to have some kind of income, right, off that money if you can actually do that. And then you want to take a portion of your money and maybe you're going to take risk on that. But what portion is that going to be? So those are all things that you need to think about when you invest.
I think some of the things that I've seen, I think it relates to what Brandon and Denise mentioned, but I think one of the other ones that we're seeing is oftentimes a lot of the family offices that we're talking are telling us their kids are investing in this stuff. Their kids are involved in NFTs, and like they've been teaching them at the dinner table for years or a fairly long time, and they've been like, pretty skeptical about it. And then finally there was something that clicked. Oftentimes there's like a certain project or a certain thing that then really turned the needle for them, and it's like a pretty fundamental shift to then be really interested and believe in where this technology is going and how it's actually going to change a number of aspects. I think there's still a lot of challenges though, right? Like oftentimes with Web3, like you're seeing these funds that lack controls that you'd expect in a fund. Like you wouldn't even think to ask about some of these basic controls that are just missing, in a lot of these Web3 funds, which is a huge, huge issue. You've got companies that have a lot of paper returns that oftentimes can't convert it, or these funds with great returns that all of a sudden go belly up, right? Or companies. I mean, like Celsius didn't disclose any issues until all of a sudden things are going very negative. And this was a lack of controls, right? And Three Arrows, like a lack of controls. Like, and so, these are things that also are creating a lot of family offices that are more sophisticated to be able to go deeper and understand these aspects. They are also looking at, when are institutional investors coming in? What does that look like? And how does that sort of help assure that there's, better controls? This is where there's probably a role for some regulators to an extent, right? To also make sure that, there's maybe some regulation on the front end to make sure that there is strong internal controls or strong processes. As a fund, we are regulated actually out of Singapore by MAS, the regulator there. And I think that's also created an advantage for us when there's all of this turmoil in the market and people are concerned about what controls look like. We've sort of been able to be a bit of a shining light in some ways and an example of all of these controls that we've put into place, and even transparency. Like we're in this industry that prides on transparency. As a fund, we give real-time access to our investors of every single deal that we do, right? So they all have a unique login that they can see the same second we do a deal. They can see the deal, the materials, they can click one button, even connect with the founders. And that's sort of our way of also, going full force into Web3 because we believe in this transparency, right? And we actually hope that more of this industry moves in that way and gives kind of unprecedented knowledge, understanding, and transparency to their investors.
All right. Brendan, would you like to add a word on this?
I just, wanted to probably finish with saying that, like the space is just moving so fast, and it is probably understandable that a lot of people, or a lot of like family offices who are not familiar with crypto, just feel hesitant. I think just to comment based on what Ali was saying, there are those moments that click, right? I mean, like it just happened for my mom too, because her Instagram got hacked, and I was explaining to her what private keys were in cryptography, and this is stuff that can't happen in crypto. And she's like, "Wow, that's brilliant! Like, why doesn't Instagram have that?" And it's just kind of like, these things they take time and they mature. But I think there are so many obstacles to overcome. It is a very early space, but I'm optimistic that entrepreneurs and very smart people will solve those problems. And we'll see why, really distributed ledgers are just so important, not only in capital efficiency, but just new ways of capital formation. So it is a very, very exciting time. I think monetary policy, one way or another, will work itself out in the next few years, and you can allow real growth assets to really reflect their true value.
Do you expect the next wave of highly successful tech companies to be answers to the incredible issues that the last wave showed that we had, or do you rather expect those companies to be completely new on completely new business models and topics that we haven't identified yet? I mean, when you look at Web3, which is a kind of all-encompassing terms that capture pretty much everything from cryptocurrency, smart contract, decentralized hardware infrastructure, non-fungible tokens, DeFi, metaverse, governance. I mean, all of this together is called Web3. Would you say that those companies will be the answer to the Celsius issues that we have been through, the 3AC issues that we have been through, or do you just expect something a completely new avenue that nobody was expecting?
I mean, yeah, to make it short, I mean, those companies that do solve problems will create value. But if you look at, I can't really comment on traditional tech markets, but if you look at crypto markets, the last 12 years they've been around, every bull market has started at the intersection of capital formation, of new ways of capital formation and distribution and adoption, right? I mean, we saw this with DeFi, Ethereum, NFTs. And, for example, one of our theses is crypto incentive projects that incentivize behavior both in the physical and digital world. And Helium was a really great example of this, where they were able to bootstrap a network, giving token as their incentive, and that allowed capital expenditures of a network to go to almost zero, other than the hardware, which allows the product or service you are offering to be a fraction of the cost of the incumbent, and that's highly disruptive, right? So Helium is doing it for networks, for telecom. Sorry, there are companies that are doing it for maps, energy that I'm speaking to as well. I expect a lot of those projects to pop up because it is a highly disruptive business model.
Yeah, I love Helium. Yeah, absolutely. I couldn't agree more.
But I certainly think it's going to be across both of those areas that you mentioned, Jean-Luc. I mean, I just remember looking back. So we started investing in gaming and blockchain in 2018, and at the time, we were much smaller than we are now. And I remember running this deal that we were doing across nearly 100 investors, some of the biggest names in the industry. And everyone would say, why blockchain and gaming? It makes no sense. It's weird. These were the types of comments we were getting. And we ended up doing the deal alone. And now that company is worth $3.5 billion. Splinterlands is a great, great company. And, one of the biggest blockchain games in the world. And it changes the way the entire industry works. And we've now been fortunate enough to be first checks behind a number of, players that have become unicorns now. These are the types of things where you do have the new emergence of certain industries, right?
Yeah. Let's just finish with, a topic that we cannot avoid. Regulation. Obviously, living in Asia, we are following the regulation very, very closely there. Singapore, the most crypto-friendly place on earth for a long time, has just announced that they are to tighten crypto regulations in the wake of the 3AC bankruptcy that was announced by Ravi Menon from MAS, the managing director of MAS. So we see a general move not just in Asia, by the way, that want to address areas and activities that are not covered by the current regulatory framework, pretty much everywhere. How do you guys think this is going to impact this revolution, the tech revolution that we are all embarked on?
I think it's exciting because I think there's a $1 trillion market of institutional money that's not in digital currency, right? And so one of the reasons they're not in it is because they want to have things like risk management and identity solutions. So the regulation that's really needed that I was sort of talking about before, and the innovation that's needed is risk management, identity solutions, KYC, so institutions can actually enter DeFi and the market can actually grow to this $1 trillion market. I think, one of the things that, has started to be discussed within banks, because a lot of the banks are looking at ways to solve these problems. So they've entered, into this market now, and they've been studying it for a number of years. So I think they're looking at ways at not permissionless DeFi, but how do you make it permission, which sort of defeats the purpose of how we know DeFi today. But the question is, will they come up with a way to do that? And when they do, you might see digital currencies for each country. Every country is going to have their own digital currency. So I think, we're moving in that direction, and I think it's very positive for digital currency. But I think the way we see things working today isn't necessarily how they're going to work in 10 years.
Yeah. No, it's I completely agree. I mean, this is I usually say that the bridge from where we are today to the next wave, this bridge has a name on it, and it's regulation, it's control, it's risk management.
I don't know if I fully agree with all of that, but parts of it. I think we'll have a split in the way that things operate, and you'll have an unregulated world that can't be shut down, and I think has a big opportunity to still thrive. And you'll have a world where parts are highly regulated, and we'll sort of see how they both sort of evolve, though.
Okay.
Yeah, I think there's been a lot of talk of something called CeFi. I don't know if anyone's read about it. It's centralized platforms with different operating models. So people, are on a trading floor, but they can actually use digital assets. So I think the banks are all looking at ways to do that. And I think, they move pretty quick and have a lot of money behind them. So we might see solutions that come out of the banking industry, unfortunately.
Fantastic. All right, guys. Tali is now asking me to wrap it up, but I don't want to wrap it up before I ask you my traditional question that I love to ask my panelists every time I'm moderating a panel. 10 seconds. Where do you see this industry being in 10 years from now? And if you were to think about one thing, just one thing that looks like science fiction today, that you totally see happening in the next 10 years, what would be your answer? Brendan, 10 seconds, please.
More things that emulate Helium's business model. I think that'll happen before 10 years. And it's kind of weird to think that people can coordinate all over the world for one potential purpose. But I think that, history has proven that will be the case.
Fantastic. Ali?
I think it's a transformation on economic models, right? We're looking at businesses that run shared economic models with long-term shared value with their customers rather than, being quarter to quarter as many public companies are.
All right. Denise?
I think we will all be using digital currency. And
there we go.
I just don't think that we've come up with the solutions yet to make it widespread yet for the institutions, but it's coming, and everybody will have a digital wallet and digital currencies. The question is, who's going to be the winner?
Fantastic. Thank you so much, guys. I mean, there's so much that we could be discussed, but unfortunately we have to wrap it up. Thank you very much, Denise. Thank you very much, Ali. Thank you very much, Brendan. It was a great discussion. I loved it, and see you later.
Thank you, guys.
Thanks so much.
Thank you.